Hi, welcome to Mizuho Americas Investment and Corporate Banking series Blindspots, which explores the evolving role of CFOs. My name is Diane Ferguson, and I'm Managing Director and Head of the Financial Institutions Group at Mizuho Americas. Today, I'm sitting down with Chris Lapointe, Chief Financial Officer of SoFi. Chris joined SoFi from Uber Technologies, where he was Global Head of Financial Planning and Analysis, Corporate Finance, and Fintech. Prior to Uber, Chris was an investment banker at Goldman Sachs. Chris holds an MBA from the Tuck School of Business at Dartmouth and a BA in Math and Economics, also from Dartmouth College. SoFi is a new order of finance company whose goal is to help people get their money right. Their products are built around their members so that they have the tools they need to take control of their financial futures. Among their products are SoFi Checking, Savings, SoFi Investments, Student Loan Refinancing, Private Student Loans, Personal Loans, and Home Loans. As part of their mission, SoFi acquired Galileo and Technisys to secure a best-in-breed technology stack for its members. I'm looking forward to hearing Chris's insights today. Welcome, Chris.
Thanks so much, Diane. Really appreciate you having me.
Well, we really are pleased to have you today. And it's been a year. It's actually been 2 years. SoFi just had a terrific quarter. You've grown significantly. And that with the backdrop of COVID, student loan moratorium, and you've also made 2 significant acquisitions. Plus, it's almost been 1 year since you de-SPACed. You've been busy. So I'm wondering now, as a public company, do you have any particular favorite insight as CFO, something unique in the process over this past year?
Yeah, so what I would say in terms of the progress that we've made over the course of the last few years, it's been a whirlwind. Having received the bank charter, gone public, acquired 2 businesses, it's been nothing but a race, but it's been really fulfilling. I think one of the things I would say in terms of insights, and one of my favorite parts of the job, and something that I didn't necessarily appreciate when we were a private company, is the fact that I get to spend so much time with investors and the research community, telling our story every single day and talking about why we're so differentiated. Our mission is something that I'm extremely passionate about, and being able to demonstrate to the investor community how we're helping our members every single day and executing against our longer term objective to being a top financial services business is really satisfying to me. From an insights perspective, we often talk about the importance of building brand awareness and having SoFi in a consumer's consideration set when they're thinking about which financial institution to go with or which products to take out. And in order to get into that consideration set for a consumer, we really need to be in front of them, call it 15 to 20 times, with a consistent and differentiated value proposition and messaging. We've worked really hard over the course of the last several years, and our marketing team has done a phenomenal job of really building that brand awareness. And we've invested heavily to make SoFi a household name. What I would say is the same approach is true with investors. They see hundreds of companies every single week, and there is certainly no shortage of opportunities for those investors to put money to work. So having a differentiated value proposition as a business and being able to build that trust and rapport over several interactions with investors while also executing in a consistent manner is really critical to getting into an investor's consideration set. And that's never been more true than in an environment like we're in today, when it's easy for investors to stay on the sidelines.
Yeah, no, that's a terrific overview, and you really have every product a consumer would want across their life cycle of financial services. So congratulations on building out such a strong platform. Looking back last year when you were going through your de-SPAC process, I was wondering if you had thoughts for companies now as they consider a SPAC versus an IPO given the current environment.
Yeah, I think it's going to depend on the company, to be honest. I can walk through, how we thought about going public and the reason that we chose a SPAC versus a traditional IPO, or a direct listing. But it's going to be unique, and different for everything single business. So thinking about SoFi and why we made the decision to go public, if we were to rewind back to 2020, we had recently purchased the Galileo business, and as part of that transaction, we ended up using a seller note in order to fund a portion of it. Given that the note was coming due in the fall of 2020, we were out in the market for the first time since joining the company in 2018, raising money in a structured way, which would not only be beneficial because it would enable us to repay the seller note, but it would also provide us with sufficient capital to fund our growth and really accelerate executing against our mission and longer term strategy. At the same time, we were in the process of applying for a bank charter, which has a number of benefits, which we can talk about later as well. In order to apply for that bank charter, we needed to have a single class of stock. At the time, we had two classes. We had a bunch of preferred stock and we had common equity, and we needed to convert everything to common. So as we were sitting there in September 2020, we had really good momentum in the business, and that coupled with interest that we were receiving from a number of large institutional investors really forced us to consider going public, because it would enable us to solve the capital structure issue that we were faced with, as well as enable us to obtain capital that we could use to fund our growth. Now, why we ended up going down the SPAC route was a function of a few reasons. First, we really needed deal certainty, particularly as a consumer financial brand. We really need to have our consumers and our members trust us. And, having advised a number of companies going public in the past, we didn't want to risk doing an IPO and having to pull out because the markets weren't conducive at the time. As you know, at that time, the markets were quite volatile. We were right at the early days of COVID. So we didn't want to have to withdraw for any reason, as that would really be brand tarnishing for us. The second main reason that we ended up going down the SPAC route is that it would provide us with the ability to present longer term financials to investors, which was extremely important for our business, especially given that we were in the very early stages of rolling out new products and services, and we needed to paint the picture for investors about the longer term financial profile of our business, given how much it was going to evolve over time. And then the third thing I would say, and reason we went down the SPAC route, is we had the ability to spend sufficient time with investors versus going down the traditional IPO route and speed dating, where you go on a 1 or 2 week roadshow, you meet 100 investors and you spend 20, 30 minutes with each one, and by the time you get through the mission and strategy of the business, the meeting is over and you're on to the next one. You never really get to go deep, and the SPAC process afforded us the opportunity to spend several hours with investors, really getting them educated on the story. So that's why we went down the SPAC route. We're happy that we went down that path. I don't think we would have done anything differently. So we're thrilled, but it depends on the company and their objectives.
Yeah, totally appreciate that. And it was a big quarter when you went. So thanks for that background. You've given some color on SoFi's mission regarding financial services for consumers, full spectrum of services. What do you think the general market is grasping in the digital transformation of consumer finance, especially since COVID accelerated the understanding of digital finance?
Yeah, so what I would say in terms of our mission, our mission is to help our members achieve financial independence in order to realize their ambitions. And when I say financial independence, that doesn't necessarily mean being rich. It means having enough money to do what our members want to do. So in order to help our members achieve financial independence, we've built out a comprehensive set of products and services that enables our members to borrow better, save better, spend better, invest better, and protect better. And we've done that by putting our member first in every single thing that we do and ensuring that we are there for them at every point in their financial journey and every day in between. That's important because our members, we feel, have been left behind by larger financial institutions who have chosen to maximize for a whole host of different outcomes versus truly focusing on what the customer wants and needs on a day-to-day basis. So we've taken a different approach and created a one-stop shop for all of our members' financial needs and done so in a digital format. And I think what the pandemic has done, the one silver lining is that it has really accelerated our transition as a market from physical to digital. So we can really no longer deny what the future of banking will look like. And we feel like we're really well positioned to meet our members' needs.
Yeah, and I think that dovetails into my next question, which had to do with your differentiator. And that relative to other high growth fintechs, and particularly post first quarter earnings, yours were extremely good, but a lot of the market reception wasn't there for many other fintechs. Maybe you could talk a little bit about that.
Yeah, absolutely. So further building on the point of the mission, in order for us to achieve that mission and really differentiate ourselves, what we do at SoFi is we deploy a strategy that we call the Financial Services Productivity Loop. And this strategy has three components. First is building a one-stop shop where each and every one of our products that we offer is best of breed, which obviously increases our ability to build trust and reliability with the member so that we win the next product after that, and then the next product after that. The second component is driving superior unit economics in each one of our products, which only reinforces our ability to drive even more variable profit. And then third is building the AWS of Fintech by leveraging the infrastructure that we've built into our business via Galileo and more recently Technisys in our Fintech platform, which has attractive returns that we can then reinvest in more innovation, more valuable products, and better services. So I'll hit on each one because it really helps paint the picture for why we're differentiated. So first, in order to win by leveraging the Financial Services Productivity Loop, each and every one of our products needs to be best of breed. So we work extremely hard, and all of our GMs work extremely hard to differentiate across four dimensions: fast, selection, content, and convenience. On top of that, we want each and every one of our products to work better when they're used together. And the reason that that's critically important is because when a member chooses a SoFi product, we need to build that trust and loyalty such that when they need the next product, they end up coming back to SoFi. And when that happens, the revenue that we generate per member increases significantly. And we don't have that second large acquisition cost associated when the member takes out the second product, which moves us much closer to achieving our goal of having the highest LTV or lifetime value in the industry. This is a huge competitive advantage for us as it allows us to offer the best rates on loans, the best rates on checking and savings, and the best products and services overall. The second element of our strategy is driving those superior unit economics. Vertical integration really helps in driving these unit economics. And we've seen that in our lending business, where we have built end-to-end processes and technologies that enable us to iterate faster, have more data, and deliver better services. If you think about it, if each and every one of our products has superior unit economics, we can again invest in better rates, prices, products, and services. And then the third element is building our tech platform in line with our vision of building the AWS of Fintech. So we ended up purchasing Galileo back in May of 2020 because we fundamentally believed that we needed to vertically integrate our checking and savings business in the same way that we did for lending. It has certainly allowed us to innovate in a much faster way at a lower cost. But even more important to that is that it's a great business in and of itself. As we drive innovation at SoFi, we also drive innovation at Galileo. And one of our main objectives with our Galileo partners is to create more value for them than they can create on their own or with other partners. And by doing that, we serve all industry participants better. So our investment in this platform raises the tide for all companies and consumers overall, which drives better adoption in this industry in which we participate. And then the last thing is having the bank charter, which we just opened up in February and has been extremely beneficial. And we're in the very early days of that.
No, that's great. That was a tremendous amount of information across the whole platform and your members. Maybe we can talk a little bit about that. In terms of the market, how are they different in terms of metrics, if you can share?
Absolutely. So we have a really large and rapidly growing engaged member base. So currently, as of the end of Q1, we have 3.9 million members. That member count is growing about 70% year over year. And those members are using 5.9 million products, which is growing even faster than our member count at about 84% year over year, which is really demonstrative of the financial services productivity loop, which I just talked about actually working. So on average, each member has about 1.52 products, and that ratio has been growing at a steady clip for the last 6 quarters, which is really quite impressive given how quickly our member base is growing. I think one of the other important elements of our overall member base and something that we tried to stress during our last earnings call and more recently is, the high credit quality and overall income profile of our borrower base. Just to give you a few examples of that, our weighted average income of our personal loan borrowers is about $160,000, and the average FICO score for that member is about 746. And then on the student loan refinancing product, the weighted average income for our members is about $175,000, and the average FICO is about 775. So overall, really high quality borrowers and member base that we're serving each and every day.
Yeah, that's tremendous. And I think those metrics are really important, especially as we enter this economic cycle now and rising rates. If you could identify what you think is the standout opportunity for SoFi across both the consumer side, whether is it going to be lending? Is it going to be wealth management? Is it going to be banking? And then the biggest opportunity on the institutional side with Galileo and Technesis.
Yeah, so you're probably not going to be surprised, but I think we have huge potential across all of our segments. For the first time, we can now proudly say that we have all of the necessary products in place and the capital and funding resources to make really good progress against our longer term objective of being a top financial institution. But to specifically go through each of the segments, in lending, we do expect to see continued growth in our personal loans business, particularly in this type of rate environment, in a rising rate environment where consumers are looking to refinance out of variable rate debt into more of a fixed rate product. In addition to that, I think there's a big opportunity to see outsized demand in our student loan refinancing business if and when the moratorium expires. What we've talked about and baked into our forward outlook is that we anticipate the moratorium getting extended through the end of 2022. But when that does expire, we think that there's real growth potential. And then in home loans, we have a big opportunity to expand our capabilities in purchase loans. Historically, we've been primarily focused on agency refis. But as we continue to build our capabilities and capacity and ability to offer purchase, that product tends to do better in this type of rate environment, which we're really excited about being able to grow. Then in financial services, we're thrilled about just having launched SoFi Checking and Savings. We feel like we have an unmatched value proposition and an APY of 1.25% right now. And we're seeing tremendous growth across the board in terms of number of new members coming in the door, the number of direct deposit members coming onto the platform, overall spend and balances. And then on the invest side, the business continues to do really well, and we expect to see continued growth there, particularly as we roll out new products and features. We just launched margin last quarter, and we're going to end up launching options hopefully by the end of this year, which will help further the growth there and overall monetization. So overall, really optimistic and excited about growth opportunities across the entire business.
That's terrific. And I think you laid out the bank charter, and that was a pretty involved process, and congratulations on that. It's certainly going to help get your members' money right. I think in the longer term, if you could talk about what's key to SoFi differentiating from some of the longtime traditional banks and the fact that they are also digitalizing their delivery.
Yeah, I think there's a few big structural differences. Obviously, we don't have physical branches, which is a large cost that is typically underutilized and a big drag for some of the larger financial institutions. We will, however, still find ways to show up in the physical world for our members to create trust and reliability. We just won't have the same branch profile that some of the larger banks do. One of the other structural advantages that we have kind of speaks to our tech platform business is that we now have a core technology that is uniquely extensible, customizable, and supports multiple products through our acquisition of Technisys. What that does is it provides us with not only structural cost savings that we can pass through to our members in the form of better pricing products and services, but it also enables us to innovate at a much faster clip than some of the legacy financial institutions, which only helps further address the growing needs of our members. So I think we're in a really good position, especially with the new acquisition of Technisys, because it's going to enable us to, iterate in a much faster pace than a lot of the peer set companies can.
In terms of the future for consumer-facing fintech, do you think it will be increasingly regulated? And you were not a bank, and now you are a bank, and maybe you can talk a little bit about your experience with that.
I think it will become more regulated, and that's primarily a result of technology outpacing regulation over the last few years. We saw that, having worked at Uber, we saw that in the gig economy industry in the 2014 to 2016 timeframe, and we're certainly seeing that now in financial services. In terms of SoFi specifically, we're obviously very supportive of increased regulation when it comes to protecting our members' interests and assets. So we welcome further regulation in sectors like cryptocurrency and retail trading, where consumer demand is extremely high, innovation is speedy, and regulation is a bit further behind. And you're starting to see that with some of the SEC regulations that are coming out. Absolutely. In terms of, how we think about this in the pre-bank world versus where we are today, a lot of people ask this question, but we were always regulated we always operated in a highly regulated environment. We were regulated by all 50 states as a lender. And what having the bank has done is we will now be regulated by the OCC, the Fed, and the FDIC. Which is actually fewer regulatory bodies and more centralized than what we were accustomed to operating in the past. So we're no stranger to operating in this type of environment and certainly welcome it.
I know you mentioned silver linings before, but COVID was an unprecedented time. Maybe you can talk a little bit more about some of the silver linings for SoFi.
Yeah, I think there were a number of things, when COVID hit that we ended up implementing and putting in place. Of all times, it was critical that we were there for our members. A few of the notable items that we ended up implementing is that we stood up a marketplace for people to get instant access to PPP loans. Second, we ended up offering extended periods of forbearance for people's loans who were struggling to make payments, basically matching what the federal offering was for over 6 months. And then third was all around education. And we educated our members on our safe haven portfolios within our Invest platform to give people options for keeping their money invested in stocks that tend to do well during market downturns and volatility. So overall, a lot of the proactive, those are only three of the several, dozen things that we did. But being there for our members every single day, especially in these trying times, was critically important to building that trust and reliability with our members.
Yeah, and I remember being on the phone with you and your team during those trying times when we're just trying to figure it out. So it takes a village. Do you have any other recent experiences you had with a challenge like this that we haven't already talked about? Because I think the last couple of years has been laden with them.
Yeah, it certainly has. And what I would say is planning has been critical to being able to moderate the impact of encountering these blind spots. As it relates to SoFi and my specific day-to-day, what we've done is we've built a diversified business and always planned as much as possible for the unexpected, and have built our products with the durability to survive even the most unexpected of outcomes, such that even when headwinds are faced, as they certainly have been over the course of the last several years, we're able to deliver strong results for our shareholders. What I would say is we have a maniacal focus on unit economics, and we structure each and every one of our P&Ls in a way that ensures that each of our businesses is sustainable and durable on a standalone basis. And one of the most critical things that we did when we first joined back in 2018 was to reduce our loan originations and really focus on quality and durability. And we also reset our philosophy and started managing the business to a 40 to 50% variable profit margin while seeking to maximize variable profit dollars. You may ask, well, why 40 to 50%? And that's because in a recession, history has shown us that losses increase, anywhere between 20 and 30% while going through that recession. So managing to a 40 to 50% margin allows us to still deliver a profit in a very tough economic cycle. This approach has certainly benefited us meaningfully over the last several years and continues to do so, every single day. To hit on the specific experience or blind spot that we've faced over the course of the last several months, I would probably call out the December 2021 extension of the federal student loan moratorium. At the time, it was almost guaranteed that the moratorium was expiring 1 month later in January of 2022. Servicers had started sending out their bills to borrowers. We were starting to see really strong uptick in demand from borrowers wanting to refinance. And we had recently finished our comprehensive annual planning process, assuming that we would have a full year of benefit of normal course student loan refinancing volumes in 2022. And we had also presented that plan to the board and got approval. When the moratorium got extended, luckily we had been planning and had scenarios run. We were able to roll out a contingency plan, redeploy capital as necessary, and resources were quickly able to mobilize against slightly different priorities. And we were still able to deliver record results in Q1, which we're really proud of.
That's fantastic. It's sort of interesting when I was hearing everything you said there. It's as though it's a digitally delivered battleship balance sheet now, right, for SoFi. And then for your diversification, which is like a portfolio management technique, between, your consumers as well as the institutional business. So you've accomplished a lot. So the last question, Chris, and it's a bit fun, but what can you share what tabs you have open on your computer right now, and
Oh
which
boy.
app is your most used on your phone other than, of course, the SoFi financial app?
So tabs open. So I've got the SoFi Q1 10Q. I have my earnings prep. I've got the Orinda Baseball Association playoff schedule up. That's been going on for 2 weeks with my oldest son and has been a lot of fun. And then I've got this podcast.
What's his position?
So he's still young. He's only 7 years old. So he plays several positions, throughout the game. He plays a lot of outfield, third base. But it's been really fun watching them grow. It's amazing how much they progress in a really short period of time.
Another silver lining of the COVID, a lot of people being able to be at home more. So
Yeah, absolutely.
well, thanks so much for your time. This was terrific, super comprehensive. SoFi's doing great, and I know you work with a fabulous team. So thanks so much.
Thanks so much, Diane. Really appreciate you and your partnership and your team.